Canada's real estate market is entering a new chapter, one defined not just by rising or falling prices, but by profound structural shifts that will reshape how people live, invest, and build wealth. From the surging demand for rentals and niche asset classes to the impact of immigration cuts and sustainability concerns, the Canadian housing landscape in 2025 is unlike anything we've seen before. If you thought real estate was only about location, think again. Today it's about affordability, resilience, and adaptation to global change. In this deep dive, let's explore the key trends shaping Canada's real estate market right now, the forces every homeowner, renter, investor, or policymaker needs to understand. 1. Affordability and the rise of rental demand. Affordability remains the biggest driver of change in Canadian housing. Decades of high price growth, combined with higher interest rates in recent years, have pushed home ownership out of reach for many. This has turbocharged demand for purpose-built rental housing, a sector once seen as secondary but now at the center of the market. Governments at municipal, provincial, and federal levels are incentivizing rental development through tax breaks, waived development charges, and low-interest financing programs. Large institutional investors, once focused primarily on condos and office buildings, are increasingly turning their attention to rental communities. For everyday Canadians, this means that the rental market is expanding, offering more options, but also at higher price points, as landlords pass on rising construction and financing costs. The gap between those who can buy and those who must rent is widening, setting the stage for long-term shifts in how Canadians view housing as a financial asset. 2. Immigration, population growth, and market balancing. Immigration has been a cornerstone of Canada's growth strategy for decades, but recent announcements to curb immigration targets are sparking debate. The Parliamentary Budget Officer has suggested that lower immigration could ease pressure on the housing supply, helping vacancy rates rise and moderating rent inflation. Yet the picture is more nuanced. While reduced immigration may temper demand in high-cost cities like Toronto and Vancouver, more affordable markets such as Calgary, Edmonton, and Halifax could actually see greater inflows as Canadians and newcomers alike seek better affordability and job opportunities. This creates a two-speed housing market, one where big metros wrestle with affordability crises, while secondary cities enjoy growth fueled by affordability-seeking migrants and economic diversification. 3. Regional shifts, beyond Toronto and Vancouver. For decades, Toronto and Vancouver have dominated real estate headlines. But today, regional markets are commanding attention. Calgary is experiencing a renaissance, with rising employment in tech, clean energy, and logistics. Despite recent price increases, housing remains far more affordable than in Ontario or BC. Edmonton offers some of the best affordability in the country, attracting both investors and first-time buyers. Quebec City and Montreal are seeing renewed growth, fueled by cultural vibrancy, infrastructure projects, and strong rental demand. Smaller urban centers, including Regina, Saskatoon, and Halifax, are becoming hidden gems for investors willing to look beyond the traditional hotspots. This shift reflects a broader reality. The Canadian dream of homeownership is migrating inland. 4. Sustainability and climate resilience. Real estate is increasingly shaped by climate risk and sustainability mandates. Rising insurance costs, extreme weather events, and shifting regulatory frameworks are forcing both developers and investors to adapt. Key trends include retrofitting older buildings for energy efficiency, green building certifications becoming standard for new developments, rising demand for properties in areas less exposed to flooding, wildfires, or heat waves. For investors, climate resilience is no longer optional. It's a key component of long-term property value. For homeowners, it may soon influence mortgage eligibility and insurance premiums. Canada's future housing stock won't just be about square footage. It will be about sustainability per square foot. 5. Niche asset classes gaining ground. While traditional residential and office real estate still dominate, 2025 has seen a surge of interest in niche asset classes such as data centers, fueled by the explosive growth of AI and cloud computing, cold storage facilities, critical for e-commerce, grocery, and pharmaceutical supply chains, student housing, which remains undersupplied in many university cities. These niches, once overlooked, are attracting global capital as investors seek diversification and resilience in uncertain markets. 6. Government policies and market interventions. Canadian policymakers continue to experiment with interventions aimed at stabilizing housing affordability. Some of the most impactful include BC's flipping tax, charging up to 20% on homes resold within a year, designed to curb speculation. Vacancy and foreign buyer taxes, which are being refined to capture untapped supply. Affordable housing initiatives, ranging from co-op housing expansions to public-private partnerships. The effectiveness of these measures remains hotly debated, but their presence underscores one reality. Real estate is political, and policy is now a core driver of market direction. 7. Labor shortages and construction bottlenecks. Even as demand for new housing grows, Canada faces a critical bottleneck: labor shortages in the construction sector. Retiring tradespeople, limited apprenticeship pipelines, and pandemic-related disruptions have left a gap that threatens to derail housing supply targets. Governments are investing in training programs and trying to attract skilled workers through immigration, but the challenge is immense. Without solving the labor crunch, even ambitious building targets may remain out of reach. 8. Investor sentiment and market psychology. Beyond the hard numbers, investor sentiment is shaping the real estate landscape. Many Canadian investors who once bought U.S. properties, especially in Florida and Arizona, are now pulling back due to political uncertainty and economic risks in the U.S. Instead, they're redirecting funds back into Canadian markets where they perceive long-term stability. At the same time, foreign investors, particularly from Asia and Europe, are once again eyeing Canadian real estate as a safe haven amidst global volatility. This renewed confidence is adding fuel to select urban markets, even as affordability challenges persist domestically. Conclusion. The future of Canadian real estate. The Canadian real estate market in 2025 is defined not by a single trend, but by the collision of many forces: affordability struggles, immigration shifts, regional diversification, sustainability, labor shortages, and evolving investor strategies. Together, these trends are reshaping what it means to buy, sell, and rent property in Canada. For some, this era represents uncertainty. For others, it's a period of unprecedented opportunity, a chance to rethink investment strategies, explore new markets, or advocate for housing policies that truly serve Canadians. What do you think? Will affordability challenges push more Canadians into the rental market for good? Or will regional markets like Calgary and Halifax become the new frontiers for homeownership? And as sustainability becomes central to real estate, would you pay more for a climate-resilient, energy-efficient home? Drop your thoughts in the comments below. Don't forget to like, share, and subscribe for more insights into Canada's fast-changing real estate market, because the next big shift could be closer than you think.